Hello, in this video, we are going to examine the different kinds of quoting interest rates. In practice, you more than often take a loan, the home mortgage, or put money into the banks as a deposit, and the interest rate the bank quotes you may be sometimes different from what you actually pay or actually get. Let's look at the reason why in these sessions. So we have two concepts: the annual percentage rate, the APR, and the effective annual rate, EAR. So what are they? The annual percentage rate is what actually the bank quotes you. It's equal in annual. Okay. An effective annual rate is the true rate, the actual rate that you pay or get. So why is they different? Look at the examples. The bank quotes you the annual rate of 7% for your home mortgage, but the payments are paid monthly. What it means is you pay every month some fraction of the home mortgage and also interest. So the 7%, the quote here, is not the true rate, is not the rate that you actually pay. This is only used to derive the monthly rate of 7% divided by 12 months, which is 0.583%. Why I said it's not the true rate? Because what did we learn in the previous sessions? Because we have interest on interest, right? We had compound interest. So let's look at the examples here. Suppose you put money into the bank as a deposit. The bank quotes you 5% annual. Okay, so you pay every year. So after year one, actually you get $105. So you get hundreds the originals and also 5 interest, right? So the 105. But what if the banks now said, okay, I give you £5, but I will pay you semi-annually, which means 6 months. What is the difference? So after 6 months, you will be paid 2.5%. So 5% now the bank quote you 5%. Okay, but pays every 6 months. So 5% is now used to derive the interest rate for 6 month period. Okay, so it's 2.5%. So after 6 months, you have the investment of 102.5. So you have 100, the original investment, and $2.5 interest, right? For the next 6 months until the end of the year, you will be also pay 2.5% interest by the bank. And after year one, this is what you have in your bank account, 105.0625. So here you earn 2.5 interest on the original investments, but you also earn 2.5% interest on the interest that you already make from the first 6 month period. Okay, so the interest on interest here, which makes the difference. This is the compound interest. Okay, so here you have the interest you already make of 5.0625, right? And the interest rate 5.0625%, which is higher than what the bank quotes you, 5%. So actually you get larger interest, right? So now 5% here is we call the APR, annual percentage rate, because this is what the bank quotes you, but it is not the true rate. This is the true rate. This is the effective annual rate, EAR. Okay. So here, 100 times 1 plus 5%. This is actually what you get after 1 year, and this is what you get after 1 year in the second case. This is 105.0625. Yeah, this is the formula, and they are not equal to each other, right? So how to find the EAR here once you know the APR, right? So what you need to do is, because EAR is the annual true rate. Okay, so it's not 5%. So it's EAR. Okay, so you let them be equal to each other. This is what you get after 1 year in the second case. To derive the EAR in this case, you let them be equal to each other. Okay, so here you can remove the hundreds from both sides. Okay, right. So the EAR equals 5% divided by 2 plus 1 square minus 1. So EAR equal, if you do calculation, you get 5.065%. And to generalize the formula, you have EAR, the true rate is 1 plus the annual percentage rate divided by K to the power of K minus 1. K is the number of compounding per year. In the case which I did, K is a number 2 because we compound to period over the years, 6-month period. Okay, so the formula to find the EAR once you got the APR quoted by the bank. Okay, you apply this formula to know the true rate that you get from the bank. So, and let's come back to the example, the 7% rate for your home mortgage. So you know that the 7% APR, the annual percentage rate, is not the true rate. What is the true rate? You apply this formula, you will get the true rate is 7.23%, which is larger than 7%. So even though the bank told you, oh, I pay you 7% for your home mortgage, actually you have to pay 7.23% if the bank say you need to pay every month. The payments monthly. Okay, so for these lessons, what you need to remember is that you should not be misled by the bank's codes. You need to have a knowledge, finance knowledge, to be able to compute the true rate from what the bank codes you. The bank sometimes may want to code the lowest rate as possible for your home mortgage and high as possible for your deposits. But of course, if the payments are not annual, for example, monthly, quarterly, something like that, so the actual rate that you get may be different, and you need to be able to figure it out. Thank you very much. I see you in the next video.